Okay, so my name's Anthony Scaramucci, as you guys know. I have about 30 minutes, so what I'd like to do is talk for 10 or 15 of them, and then if it's okay, take questions, because it's just always a lot more fun for me if we can make it interactive. But, just talking a little bit about SkyBridge Capital, it was started in 2005 off of a PowerPoint presentation, and the original concept was we were going to back early stage managers. We were going to give them some starter capital, take some of their revenues for our clients and get them up and running and get them to start growing. That was 2005. We raised a $330 million fund. Okay, so we had no track record. It was a blind pool, and it was a 3-year lockup, and it was a halcyon environment to raise capital in. Okay, this product could never have been raised post September 15th, 2008. Not even possible. Okay, so I want to talk about how we think about the business, but I also want to talk about the new reality that we're in. Okay, so when we talk about differentiating as it relates to marketing, the SkyBridge Capital model, this incubation idea, was that we were going to provide a investor with a return from the fund, but then they were also going to share a piece of the fees. Okay, so that seemed pretty cool, right? That seemed like a differentiation. It seemed like it was, I said once to somebody, it's like net jets for hedge funds. You get a fractional ownership in the hedge fund. You actually can get a piece of the business of the person that's managing your money. Okay, now the business has been okay to mediocre, primarily because of the 2008 crisis. What we were able to do at SkyBridge, though, is we were able to purchase from Citibank their fund of funds business and their hedge fund seeding business, which has now morphed SkyBridge into $7.4 billion. We have about 40 funds on the fund of funds side that we allocate capital to, and I'm just going to give you some of my observations from these funds, from their PowerPoint presentations, the way they style themselves, and the way they market. But I just want to give you, before I do that, a little bit about why I think we're in the fashion business as opposed to the investment management business. So let's go to 2006, and I just want to try to get people back to where we were in 2006. All the rage in 2006 was to invest as if we were a college endowment. Okay, and the leading thinkers at that time were the guys working at Yale and the guys working at Harvard, and we were going to have a 75-year horizon, and the bulk of the money was going to go into private equity. And the reason why private equity was so popular is that you were going to get a huge capital return from the private equity investor before you put your last or your third capital call into the fund. Okay, and so all the rage, very much in vogue, 75-year time horizon. All of us, families, individuals, institutions, we're going to invest like the Harvard Endowment. Okay, now fast forward to 2010. We're in the ATM environment now. Okay, we have total transparency. We need the money out of the hedge fund in 30 seconds or less. And of course, most of the people in the hedge fund industry are criminals. Okay, and so therefore we need to have all these bells and safety whistles. Okay, so I submit to you guys that neither one of those ideas are right. Now, some of you may have seen me and President Obama discussing the issues of Wall Street and whether Wall Street should be getting hit with a piñata. I personally don't believe so. Okay, do we have rogues on Wall Street? Yes. Do we have bad people on Wall Street? Yes. But there's 7.5 million people in the industry, and I just cannot believe that every one of those people needs to get hit in the head with a piñata stick. So we can talk about that in the questions and answers. But my point is, when you overgeneralize, whether you're the President of the United States or you're an investor, when you're making these overgeneralizations, there's a ton of danger in that. Okay, so, and like it or not, we're, as a social organism, human beings, we like to herd. Okay, we don't want to ever be perceived to be stupid. Okay, at a J.P. Morgan private banking conference, Jamie Dimon invited me. I told these guys, rich people want two things. Yes, Wallace Simpson said you could never be too rich or too thin, but what rich people want is they want to stay rich and they want to look smart. That's what rich people want. So you don't want to get caught in a small fund that's going to fail. You don't want to get caught in Bernard Madoff's fund, and certainly when you were bragging about Bernard Madoff at a cocktail party before he went to jail, after he was put in jail, you forgot that you had that investment because you don't want to look dumb to anybody. Okay, but in the process of doing that, what ends up happening is you miss a lot of great opportunities. So let's just talk about common sense for the investor, and then let's talk about how a hedge fund manager can differentiate himself, he or she can differentiate themselves as it relates to how they're marketing. Okay, so common sense for the investor is that the endowment model is not right. Not even the endowments can invest like the endowment model. You just have to go to Allston, Massachusetts, and see the empty buildings Harvard stopped building. So the endowment model is not the right model. If you think the ATM model is the right model, I submit to you that you're going to make a very big mistake because there are huge, successful hedge fund managers that none of us know about right now that are being developed and are being formed. The next Dan Ock, the 2020 or the 2025 Dan Ock, is starting right now. Somewhere in the United States, somewhere in Europe, somewhere in Asia. They're starting with $50 to $150 million of capital, and they're going to knock the cover off the ball. Okay? Same way John Paulson had a great business, good to great business, made a couple of very concentrated bets, and it became a super colossal, fantastic business. Okay, so as an investor, I submit to you that you have to have a portfolio, okay, that is well-rounded. You have to have some stuff that is short duration, you have to have some stuff that's intermediate duration, and you have to have some stuff that's long duration. But you also, as a hedge fund investor, you can crowd around with some of the big guys, but you should also have some of your money in, safety-sealed, smaller managers. Okay, so here's some of the things I would say to you about being a hedge fund manager and how you can differentiate yourself. Okay, number one, okay, and this is the number one thing for me, and this is the number one thing for our firm in terms of how we're guiding people to think about it. As a hedge fund manager, you've got to participate more on the fundamental side now than the momentum side. And you have to articulate yourself in a way where you can convince people that your fundamental analysis, okay, back in the day, you could be in this whole momentum trade and you could watch the leverage and the tsunami of leverage carry you forward to your 20% bogey. But today, it's very, very different. Okay, so as a hedge fund manager, you want to differentiate yourself, you better be demonstrating to people that you have a fundamental understanding of where to find value. And you have the patience and you have the discipline and you have the will to stay in those trades. Okay, so that's number one. Number two, and I really believe this, okay, you better get to a standard in the hedge fund side on operations that is an acceptable standard. Now, I don't know if you're in Europe, perhaps it's a UCITS standard. In the United States, perhaps it's just having the best custodian, the best accountant, the best law firm, and some other third-party pricing services that can get people comfortable with your business. Okay. Number three, okay, and I think this is as important as the first two. Okay. Particularly if you're an early-stage manager, if you are a new manager, okay, the only way that you're going to be able to differentiate yourself to a firm like SkyBridge, okay, is by getting the one key thing. I don't know what it is. If I'll just give you an example. If you're a capital structure arbitrage person, you've got to hit somebody with a with a PowerPoint presentation that has several really tight base cases on what you're doing. If you're into risk arbitrage, you better explain why you think the macro environment, okay, is such that augurs well for risk arbitrage and how you're going to position your portfolio to take advantage of that. Okay. I see time and time again, I must see 700 to 800 PowerPoint presentations a year from various hedge fund managers. They all look the same. Okay, it's sort of embarrassing. It's like you went to the hedge fund word processing center or the hedgefund.net.com and you printed out the PowerPoint presentation and you just slotted your name in. Everybody's got the same pedigree. Everybody's got the same investment theology. And the other thing is everyone's never made a mistake. Did you know that about hedge fund managers? Okay. The most differentiating PowerPoint presentations for me are the lists of failures. Here's what I did in the trade. Here's why the trade failed. Okay. Here's what we did to correct ourselves. Okay. You want to differentiate yourselves from people. Okay. Demonstrate adaptability, resilience. Demonstrate the ability that you can call yourself out on something and admit that you're wrong. You know, I just believe that. Okay, I've been in presentations where we're marketing SkyBridge. I turn to people straight up. I say, you know what? SkyBridge could have been no bridge or blown up bridge. 2008, 2009, very difficult period of time for SkyBridge. Okay, how were we trying to differentiate ourselves at that point? Okay, for me, I looked at it, I said, okay, we're in trouble. The Dow's at 6,500. It was February 2009. How are we going to stand out? How are we going to make ourselves look different? Okay, President Obama, February 2009, he got on the airwaves, made another very overgeneralized statement. He said, now is not the time to go to Las Vegas. Okay. So what happened? Everybody that had TARP money canceled on Las Vegas. Goldman Sachs canceled, Citibank canceled, Merrill Lynch canceled. The city was under siege. Yes, you want to take out the fat cats. I understand that. I understand that that's an agenda, but you're hurting the maids and the porters in the city of Las Vegas. These are common middle-class people who are getting laid off because now no one wants to go to the city of Las Vegas. So SkyBridge differentiation, one of my partners comes into my office and says, hey, we're entrepreneurs. Everyone's canceled on Las Vegas. We got to go to Las Vegas. We should have a hedge fund conference. Okay, I'm looking at that saying, okay, this could be our last hurrah. Okay, we could be going out of business and we'll have a big party in Las Vegas, or we'll get lucky. We'll catch the bottom of the market. We'll catch some fanfare from being in the city of Las Vegas, and we'll have a hedge fund conference. So I called the mayor. I called the governor of Nevada. I got Michael Milken, who has a house up in Lake Tahoe, who's a big Vegas supporter, to agree to be my keynote speaker. We got General Wesley Clark out there with Dick Gephardt. We had 500 people in the city of Las Vegas. Okay. This past May, we had 1,500 people. We put Bill Clinton in the room with Governor Romney, General Peter Pace. Michael Milken returned. I don't want the conference to be a partisan conference, because I'm really not a partisan person, but I want it to be an ideological one. Okay, I want it to be a conference that represents thought leadership, ideas, energy, and innovation for the industry. Okay, so you see, I'm bringing this example up because it's a differentiating piece to the SkyBridge story, and it required us to think differently. Okay, if you want an ordinary result, think like everybody else around you. If you want to have an extraordinary result, you have to think extraordinary. If you want a non-conventional result or an unconventional result, you have to be unconventional.